Welcome to Heritage Wealth Planning, my friends. We're going to talk a Q&A. We'll start doing segments, shorter clips on questions that I receive or comments that I receive that I want to comment on the YouTube channel. So if you have any questions or comments and you want me to address them, email me or put them in the comments. I'll do my best to get at them. I mean, I don't know how many I'll get. I frankly don't know. Maybe every other day or every couple days or something. But I'll keep a running tally of Q&As, questions which I'll answer, comments which I'll answer, and I'll get to them at some point. So I'll keep a tally of Q&A. In fact, I'll even start an email file in my email that says questions or comments that I want to address. So if you have a question or comment you would like for me to address, just put it in the notes there or email me and I'll deliver it at some point, hopefully. We'll see. But anyway, I think it'll be pretty interesting. We'll try to make these a little bit shorter segments. So here, don't forget to subscribe, by the way. So I had a comment from a guy when I was talking about estate planning basics. In terms of the capital, when you get a cost basis, a step up in cost basis, i.e. I had a stock I bought for $100,000. When I died, is worth $250,000. I gave it to my kids. My kids now have a cost basis of $250,000. And if they sell that stock for $250,000, they owe nothing in a capital gain. That's called a step up in basis. Now, what this one guy was saying, and I get what he's going at, he's saying, hey, to help reduce some of the stress on the estate, more seamless transition, you should name your children name them as a title, basically give them ownership rights. And that way, because it'll be joint tenants with rights to survivorship, it'll bypass probate. There'll be no fuss, no muss when they inherit the property. It's easy. And I said, don't do that. And I mean, be advised, everything has a situation dictates, everything. But in this case, we don't want to do that. And I'll share that with you right now why that is. All right, so here we got Joe. Joe's the dad, and we got Janie. Janie's the daughter, okay? Joe bought a stock, whatever it is. It doesn't even matter what it is, but something outside of an IRA or 401k for $100,000. Right now, it's worth $250,000, all right? So he has a $150,000 unrealized gain. Make sense? So now, Joe dies. This $250,000 goes to Janie as her basis. So now Janie, she has this $250,000. If she sells it for $250,000, no tax due. If she holds it for a couple months and sells it for $300,000, she will pay short-term capital gain tax on $50,000 because her basis is $250,000. So if she sells it for a higher price than what she inherited it at, depending on how long she owned it, in this case less than a year, she's going to pay tax on $250,000. If she sold it for $300,000 after holding it for over a year, she'd pay long-term capital gain on $50,000. All right, so far so good. Now, again, what if she held it for 6 months and that's her cost basis, and she sold it for $200,000? Now she has a $50,000 loss, which she can carry forward to offset other $3,000 a year in income or other gains that she has. And so that's how it works. This $150,000 of unrealized gain transfers to Janie without any taxes whatsoever, none. That is her basis going forward, and that is what's based on the taxes of when she sells this property is based on this right here, her cost basis. She sells it for a gain, she'll pay a tax. She sells it for a gain as she hold it for a full year, she'll pay a tax as long-term capital gain. She sells it for a loss from what her basis was, she will get that loss carried forward, which she can, again, use anytime she wants to offset other gains or offset $3,000 of year income. And she should use that, because if she doesn't, again, as we talked about another video I just did, it will go, it dies with her. Capital losses die with you. Don't die with a capital loss. All right. So now, Joe says, well, I don't want Janie to have to go through probate. So what I'm going to do is I'm going to add her name to the title of this account. I want her to be a joint owner, joint tenants. So now what happens here is we split this. So now Janie has $50,000 as her cost and a half of the market value, $125,000. And Joe also has $50,000. What just happened? Okay, said a weird noise. So Joe also has $50,000 as his cost and market value of $125,000. Because what Joe has done here is he's literally made a gift of what's that? $125,000. He made a $125,000 gift to Janie. Now, there will be a gift tax form he'll have to fill out, an IRS form 709. That's a gift tax form. Highly suspect there won't be any gift tax due, simply because unless he has given a whole lot more of millions of dollars away over the course of his life, it won't be subject to gift tax, but he does got to file gift tax. So what happens is when you make a gift, the person who receives the gift is inheriting, I hate to even use inherit because that sounds like you're died, is going to receive your basis. All right, so in this case, you gave halfway the asset because you said, Janie, I want you to be a joint owner on me, so we're going to split this asset into two. You own half and I own half. And what you've done is you said half of my basis, and again, my basis was $100,000, transfers to you now. All right, half of the account value transfers to you now, because essentially, and I mean, you both own 50%, you both own 100% of it, but at the end of the day, there's only $250,000 of value in there. And so from a tax perspective, when you made that gift, because you're still an owner, and now Janie's an owner, you're essentially saying we both own 50% of this property. All right, so when you're making a gift, you're transferring some of your basis over to your recipient, I guess, or the gift, yeah, the recipient, the giftee. All right, so that's bad, because I'll show you why. So I don't really even care about the gift tax consequence, because there just isn't going to be much for the vast majority of people out there. The vast majority. I don't care about the gift tax. You really need to file the gift tax form 709. It's a one pager, my friends, no big deal. All right, now Joe dies. All right, so what happens now? Well, Janie gets the market value of Joe's half of the account added to her cost basis. So we add these two things up, and now what happens is new basis is what? 125 plus 50, $175,000. Now the account value is still $250 because Joe's $125,000 plus Janie's $125,000 is still $250,000 as the account value. Let me do this as account value. Do market value is still $250. All right, so now I hope that makes sense so far. So now what happens is, if Janie sells this, she's selling it for $250, but she has a $175 cost basis, which means she'll have $75,000 of either short-term or long-term capital gain, depending on how long she held the property after she inherited. If she sold it right out of the gate, she'll pay $75,000 as ordinary income, which is the exact same thing as short-term capital gains. If she held it for a year, she will pay $75,000 in long-term capital gains. In this case, it will be taxed at 15%, simply because she'll have more than enough income to put her in the threshold where you're going to pay capital gain tax. All right, so that's what happens. Now, again, because her basis is $175,000, if she sells it for $200,000, which is $50,000 below, so she would lose 20%, take a 20% decline, and still sell for $200,000. She still has a $25,000 gain, because her 175 basis is the basis. Anything that she sells it above that will be taxable. But remember, they had a $250,000 account. It drops 20% in value. She will still pay a capital gain because her basis is 175, and yet her market value is 200,000. So even though it went down 20%, she's still going to pay a capital gain on that 25,000 bucks. And that, my friends, is how you don't want to add a person to your account in order to avoid probate or to make a seamless transition of your affairs, simply because you can do that with just a transfer on death. You call your Vanguard, I want to add Janie as a transfer on death. Okay. Nothing changes from Joe's ownership of the property, but at the end of the day, all Janie has to do is call Vanguard. My dad just died. Here's a copy of his death certificate. Here, I can prove to you I'm Janie. Give me the money. That's all you got to do. So and that avoids probate. There's no probate fee, no probate asset, no need for a lawyer or anything like that. It's just a beneficiary designation on a mutual fund or a brokerage account, or a POD, which is for a bank account. You're probably not going to have the same in this case with a POD because banks don't pay much. But at the end of the day, a TOD solves this without question. Or you can put it into a living trust. I mean, I'd challenge that to some degree, but you still could. You could put it into a living trust for sure, and that avoids probate as well, and without sacrificing the potential for the step-up basis on the entirety of the account. So the lesson to be learned here, and I'm not even talking about real estate, I'm just talking about assets, financial assets. Real estate's different because there are more rules and regulations. There's a little bit more of a pain in the butt to add someone to your deed. But just for financial applications, this is easy. I mean, you just call Vanguard, I want to add Janie to my account. They'll do whatever they do because they're literally starting a new account. They're saying, well, Joe, we have to open a brand new account. That won't be a taxable thing, but we have to open a brand new account from an individual account to a joint tenants of rights of survivorship. You're opening a new account. I'm telling you, don't do that. Now, there might be reasons in which to do that, but for generally speaking, don't do that as simply a way to avoid probate and make it more of a seamless transition for your heirs. You could leave huge tax, you could create huge tax issues that you're unaware of. So, as always, it's went a little bit longer than I wanted to, but still, if you have questions or thoughts, put them in there, email me, and I'll, like I said, I'll keep a running tally of stuff that I'll get to, and we'll see you next time at the Heritage Wealth Planning YouTube channel. Do not forget to subscribe, thumbs up as well, and comments are welcome. We'll see you next time. Thanks, guys.